So thanks everyone for coming. I've made the long journey from 2 floors up, so I'm sure you can appreciate my struggle today. So I used to work at an investment bank. I didn't do this. It was closer to this, but specifically it was more like this, not all the time, but thanks to a colleague of mine who decided this was a good moment to snap a picture of me. So I'm Huss. I'm the co-founder and CTO of 9fin. At this stage, when we're only 6 people total, CTO means I just make all the unpopular decisions and just another member of the engineering team at this point. Before that, I spent a few years in investment banking technology. And because I was in the technology area, you end up working for a whole department rather than specific areas. So it means I got to see a lot of interesting things, which we will touch on through the course of this talk. And before that, background in aeronautical engineering, which involved the areas I found interesting were things around computational fluid dynamics, which are of course linear systems, and flight stability and control, which is about signals processing, and airline fleet scheduling, which is all about optimization. And little did I know that these touch points will be following me around for my whole career so far. So we're at 9fin.com, at 9finHQ on Twitter, and AngelList is where you can find information about our open roles and positions. So let's get going. The title, first of all, buzzword alert. You just kind of have to have that in there these days, I think. But this is a very interesting topic, and it has been for a number of years now. I don't think there's any sign of it becoming less interesting. The revolution I'm talking about is not just by us alone. It's really important to say there are a lot of really other interesting applications of this new wave of machine learning systems and tools in capital markets in particular. And we're just another line of people trying to advance to push the needle forward. And financial markets is a pretty broad section. So we're going to break it down. This is our company tagline. Again, what does that mean on its own? So what I'm going to do today is I'm going to break these down, and I'm going to work backwards through them, explaining each bit and how it eventually fits into what we're doing. What we're doing is an interesting part, the first part of the start, really, where I give an overview of financial markets. So using computers in finance is not such an open secret, but it's been a lot of references in pop culture. See Flash Boys by Michael Lewis, talk about high-frequency trading. We typically only hear about it when things go wrong, and we tend to go wrong in a very big way. 400 million lost in 30 minutes by one particular fund. Anti-fraud, many great companies in this area. And recently we're seeing more about robotic advisors and algorithmic ways to place your own personal savings and investment. But on the public markets side, we've been hearing about AI for the last 8, 6, 7, 10 years maybe, but we haven't heard much from financial markets. And I think that's partly intentional, because we like to keep a lot of things secret. So we're going to quickly do a quick recap of what's been going on, because it has been in use since the early 90s. So what is actually happening in these dark boxes? So the objective is actually not too dissimilar from any thing that you guys might be working on yourselves. It's to make a model, and the objective in this case is to try to predict the future outcomes of an asset. And as with any model, what's the input? In the case of financial trading, there's kind of 2 sub-areas of economics, macro and micro. Macro deals with the sum aggregate of economic indicators. That can be GDP, employment, spending, tourism levels. Microeconomics deals with kind of specific signals coming from individuals, such as the prices, the number of orders, the news, and even things such as the weather can drive these types of signals. On macro, the issue with them is that they're lumpy and laggy, the metrics. So GDP growth maybe comes once a quarter, and when we get it, it's for the last quarter. You're not really able to make very exact and precise predictions. And on global scale, a lot of crazy stuff can happen that can just throw off things. See what's been happening since last November. And on micro, the hard part is that it's just really difficult to accurately make that model in the first place. So this kind of, I'm lumping this all in quantitative analysis. And what that is a method and set of tools that are used to derive these models and make these predictions by which these markets are expected to behave. And expected is the key word in this in his sentence. And at its core, it's just a bunch of statistical tools and methods used to determine what is the perceived fair value or true value of a particular asset. And then actions are taken accordingly, whether to buy or sell that particular asset. So we're going to go over a very simple example. This is the 5-minute period price chart for an FX conversion from dollar to euro at the start of this year. And one of the particular models that people have been using, it's not used so much in this particular form now, but it's one of the simplest ones that I could explain in under the time I have here, is that the individual price movements over these small periods of time are random. By experimentation, they haven't really found a known distribution yet. So by extension, it's a normal-ish distribution with an average and a standard deviation. And prices are expected to kind of track and go around those types of, go around that average. So how does that translate into a model, and what are the signals that we're going to pass into it? So what are we looking for? Here I've just plotted on top of that data, the simple moving average across 10 periods, a period being that 5-minute section, and upper and lower bounds of standard deviation. Now, if you got the email from Lenny today, this is exactly what he was doing. He was telling you, what's our average rate of attendance here and what's the average, So what we're looking for is if something crosses the upper bound, it means, okay, is this normal? Is this normal behavior? Has it, in its historical period, has it exceeded this before? And if it has, then you go, okay, well, it's likely to return back down. And the idea is to predict these drops and gains. And actually, what happens in practice, you're actually trying to spot when you're in them. Because getting this correct is really, really hard. And this is a very simplistic model. In fact, one thing I realized since leaving my job at the bank is that I'm not able to get as much market data as I used to be able to. So I could only get the last 6 months of overall prices, and I only could get the last 4 days of these intra-period prices, which is nowhere near enough. And it goes without saying, I strongly advise against trying this strategy yourself with any real money. So what goes into the model? It's not that simple, as I just alluded to. So we've made a lot of assumptions. We assume that we get the exact price we want. So if it goes over a certain point, I want to get that exact point. Probably won't happen in reality. The data, as I said, is not good enough. We need a lot longer sample period to accurately get the standard, to get the amount of variance in that particular instrument. And you would test this to death. This works now for something I did yesterday evening, but who knows if it would hold. You would never go into a position like this, like unhedged, without some sort of protection against it going wrong. But adding in hedging mechanisms further complicates your model. As many other factors affect the price. And in particular, currencies are particularly sensitive to geopolitical stuff, which are purely statistical type method, like I showed us before, doesn't even take into account. And if you borrow money or assets, you introduce a whole world of trouble, which, new risks and new variables that need to be accounted for. Seriously, don't do this unless you're a professional. So the archetypical example of this is a company called Long-Term Capital Management. And with a name like that, I think you know where this is going. These were a quantitative hedge fund filled with quants and statisticians and Nobel laureates. If any set of people were to be the ones to get the model correct, it was going to be them, as they thought. So they used a strategy called a convergence strategy, which is saying that two similar assets should be the same price, but they're not at the moment. So they take advantage of that particular price dislocation, and they hope to pocket the difference as the head profit. So they had models which predicted not only the future expected prices, but also picked which pairs or triplets of securities to buy and sell to implement this. And they were really highly levered to kind of make the most of this strategy. And it was all great until it wasn't. So this is the fate of $1,000 with long-term capital management from 1994 to 1998. So they lost $500 million in one day, twice. So probably don't do this either. What happened here? Remember how I said a lot of unexpected things can happen in macroeconomics? Well, Thailand defaulted on their debt, shortly followed by a Russian debt restructuring, which sent a shock through the market. The model assumed this wouldn't happen, or at least to the degree that it was so unlikely that its effect wasn't factored into what they're doing. This ultimately led to the miscalculation of the true risk the fund was exposed to, and then ultimately, the cost to service that risk in the form of everything they had borrowed against to kind of to play in this market. This is what we would term model risk, and I actually hadn't heard this phrase since I left. And when I was putting this slide together, I realized, actually, this is what this is. And what it is, it's the quantification of the worst case scenarios of what happens if your model is incorrect. And there's plenty of academic papers on this and trying to quantify this. And I thought, could we learn from finance in this particular aspect in terms of the current new applications we're seeing being developed with machine learning techniques? Because it's not a big deal if the wrong song gets recommended to me, but it's a bit more of an issue if a car decides, oh, that's a bridge when it's a pier, maybe, for example. So what's changed since that time? Well, that set of strategy that I was talking about is in the bucket of regression, which is kind of trying to find trends from historical data. And other things are also used in this particular sphere, convex optimizations and signal processing, which is still heavily in use today. And it's the basis of many automatic execution type algorithms used in trading firms and banks today. But the direction they took is they decided to optimize on speed, which is what you're hearing about now, rather than real model advancements. What is a new architecture? So, $300 million was spent, I guess, 2010-11 time to lay a dedicated fiber optic line between Chicago and New York, which are two main trading hubs in the States, for a grand total reduction of 0.92% in the round trip time. But anecdotally, that line paid for itself very quickly. So what next in this particular sphere? The research output is starting to change. We're starting to see people starting to explore the new architectures that have been all the rage of the last 4 or 5 years in non-finance applications, such as deep neural networks or random forests. A couple of interesting research points I want to highlight. There's Quantopia has done some research into the predictive power of different models. So which factors of the models that are these traditional types of models, which one has been more effective in proving out. So this one says that tail ratio is the biggest impact, which is basically how much you think the unlikely is going to happen. And from the long-term capital management scenario, it's quite clear that was the biggest driver for them. And the new paper just out last year, and it's nothing to do with finance, but an interesting point that's stopping the adoption of these deep neural network-based techniques is that it's hard to explain what's going on. You can't really say to your manager, yeah, I did the wrong trade, I don't know why. But this is a really interesting paper, which is trying to turn the outputs of a neural network into a decision tree, which is more of a thing which you can explain away if something goes wrong. And if any deep neural network otherwise is being used by hedge funds today, they probably wouldn't tell us anyway. So there might be some people in this room who do work at such establishments, so we might find some stuff off the record today, maybe at the pub afterwards. So switching to bonds, the credit markets are a very different structure to equities and currency markets. Before, you had multiple input vectors of single dimension going to make your input, but in credit markets, the input vectors themselves are multiple dimension and they're all linked. So it's all about the provision of credit, which is a loan, to a party. And the assessment is made both on what the party wants to do with that money and the party itself. So the home mortgage is a very good example in this case. You're assessed based on age, salary, credit score, number of children, spending, all kind of things. So in essence, you need a number of extra and indirect metrics to make a decision in aggregate. So stepping back through our tagline, extraction now. This is what a bond prospectus looks like. Everything you'd want to know about the company and what it's intending to do. It can be anywhere from 300 to 1,000 pages long. This is one of the short ones. And so, when this arrives on your desk, you might go, cool, let's try and find what the last revenue number was for this particular company. So you might follow this process, open the table of contents, watch out for Roman numerals, find the appropriate section. You can either start reading or just random page access, whichever one you fancy. And if you start reading, you find it's on page 1, paragraph 4, line 1 to 2, or if you flick through pages, you're looking for a table, you find it, and you find your answer. But, revenue is the same as sales, is the same as turnover, and you'll see all three used maybe, across different documents. And that's the problem that we're dealing with specifically. So in this particular area, the financial data we're looking for, where we are looking for these types of different indicators. We're looking for the income statement, we're looking for the balance sheet, we're looking for the cash flow statement. These are often called the credit fundamentals because these fundamentally let you decide whether this is a good credit to lend against. But compared to the other markets and compared to the example I gave earlier, debt is a few decades behind in terms of utilizing data in the same ways as maybe stocks and FX is at the moment. Because data is sparse, it's not standard, and it's very variable, as we saw on the last slide. So what's our part in the story? This is one of my favorite ex-KCD comics. So if you can't read it, it's there's someone standing behind, presumably a programmer, and he says to her, when a user takes a photo, the app should check whether they're in a park. He goes, oh, sure, that's fine. That's just a geographical hookup. That should be a few hours. Oh, and also check if there's a bird in there. And then the reply comes back, I'll need a research team in 5 years. So not saying that we're doing the impossible, but the problem really morphs in nature when you're dealing with this maybe, might be, is it the same thing? And that's the barrier that we're trying to break down. So just to get towards the tail end, two of the pipelines that we run in our system today are bookmarking and financials extraction. Bookmarking lets us classify the different parts of the document into a standard table of contents, and we add that to every document that passes through us. And this was so awful when it first started. This was like just getting everything wrong all the time, but that was a year and a bit ago, and it's thankfully much better now. And financials extraction, has anyone tried to copy paste out of a PDF before? I thought so. So you're just going to end up reading the whole thing, which you should be doing, as a prudent investment analyst. But then you're going to get to manually transcribing the data out of the tables into an Excel. We go from this useless, really, to every cell in the right box, in the right place. So this is an output from where we were at about a year ago. And what we need to do, we needed to look at the pages and extract the data. Because for us, it was important to know where something was, not just that we found it. And it's not doing great at deciding that this is part of the same section. Each time it changes color, it means it thinks it's a new section, which is completely wrong. That's why it looks like that block in red should all be one section. So it can feel like you're failing for a long time when you're trying to employ these types of methods. So for us, what's next? We're going to carry on making these predictions and serving them out to our clients on our platform. Feature engineering is a big part of what we do, as probably consumes a lot of your time picking what to actually learn on. What we're looking at next is combining subsystems with different ways of behaving to see if we can get it improved and improve result. This is just an output from an intermediate layer in one of our new systems we've been working on. So as I mentioned earlier at the top, my interest in kind of optimization and machine learning building blocks very much runs out here. So we had to bring in the pros. So Sean, who's been in our team since day one, he has been working on this, and he's here at the back if you want to have a chat with him about this. So wrapping up, application first. We are at the Applied AI Meetup. Everything has to be grounded in the domain that you're kind of solving for. We kind of came to this problem because we were originally solving the problem of just improving the quality and state of data in the debt markets, and then we realized, okay, there's a whole different problem here about extraction that we need to try and hit first. And this will be your whole guiding compass when you're trying to interpret a result that's weird or something, or trying to decide what to do next. It's no surprise that 4 out of 6 of our team directly came from a bank before starting with us, and that's across both the business side and the tech side. Helps us to narrow down the solution space, because you have enough issues without trying to go for some generalized system. And also, final point of kind of advice is to build it as a system from the start, because you eventually aim to have this running and serving things out. So you need to get it off your laptop as soon as possible and put it, make it as part of a pipeline. Even if it isn't serving insights out, this will help you test scalability, failure modes, can it recover from testing, which are all important things, but you don't want to leave right at the end of your kind of build process. Feature engineering, as I said, as I keep saying, has really turned out to be a big part of our time. And it'll feel like the head time sometimes, but you just got to push through. And finally, the old assumption of zero marginal cost in software is kind of starting to wear out, because especially in this space, it takes so much more effort to kind of get to starting again. The systems aren't really stateless. You kind of have to, your data in its current state forms a part of your past, present, and future, basis of your state. And I heard one of the previous talks here saying, you should think of machine learning and AI as just another paradigm to kind of with which we'll build complex engineering systems in the same way as object-oriented came about, microservices came about, and just because there can never be enough XKCD comics. This one recently doing the rounds on the internet last year. I think it's a very appropriate note to end on. Thank you.